With Capstone Realty with my go-to loan officer, Rachel Drummond with VIP Mortgage. We are talking about, can you really buy a home as a quote first-time home buyer, which essentially means that you have not owned a home in the last 3 years.
Right.
Can you really buy a home with zero down, or is there a catch? And either way, like, what are those programs and what do they look like? You're going to hear a lot less from me today, except for inquisitive questions, and a lot more from Rachel.
Awesome.
So I've learned today that there are actually 2 zero down programs. So can you tell us about each one of those?
Yeah. So there are a couple programs that are out there that offer zero down, and as Megan said, are they really zero down? They're promoted as zero down, and in some cases, you really can get into a home with nothing out of pocket. Now, do you fall into that bucket, right? And that's always
the question.
That's the question.
Yeah.
And unfortunately, it's too broad of a question to answer, but I can give you some ideas.
But you might be surprised that you do.
Correct.
And I think the goal of our little video today is to give you some of the important facts that will lead you to say, maybe I can own a home. If you're paying, let me just put it to you this way. We talked about this earlier. If you make, what is it, less than
$105,000.
$105,000 a year
combined
between
you and your spouse,
or
just yourself.
Yeah. And if you have, we can't give numbers because there's a range, but if you have a good credit score, right, and you don't have a lot of debt,
right,
all of these factors kind of combine together, and maybe you're paying $2,500 a month in rent right now. You can own a home, and Rachel's going to kind of talk about, quit giving paying someone else's equity, quit letting someone else go have a vacation and a party, like start building your own equity, and here's a couple of the ways you can do it. So let's talk about the first program. It's called
Home Plus. I really like to talk about both because depending on your specific situation, you may qualify for Home Plus or Home in 5. One of them essentially is a conventional program, and one of them essentially is an FHA program. And those are 2 different things we could talk about through another video, is what's the difference between conventional and FHA. So really the nuts and bolts of both programs is you could qualify for up to 7% down or 7% in grant assistance. How that's split up is essentially up to your specific needs and your specific, let's call it financial profile. What's your credit score? What's your debt to your income ratio? How much are you looking to qualify for? So based on these factors, we'll basically tell the lender, myself, which of those buckets you fall in between one or the other program. I did want to tell you though, you don't necessarily have to be a first-time home buyer to qualify for these programs. One of the programs, if you qualify, you could have owned a home 6 months ago. That program is a 5% down program, and there is grant assistance up to 5% down. So essentially, that down payment can be covered by that grant program.
And so the caveat here is, what sometimes people don't understand when they hear like a zero down program is that if you've never bought a home before, this is kind of a backtrack, you also have closing costs associated. And in the current market that we're in, which is very much a seller's market, we're not getting a lot of seller concessions to help cover those closing costs. So it's just to be prepared for, depending on where you fall with the grant, like let's say maybe you qualify for 3% or 7%, there's still going to be other costs that are associated and different fees and things like that that come along, and you may have a higher interest rate. It does sound like perhaps your PMI or your mortgage insurance may be a little bit lower, which if you don't, I wanted to talk about this, if you don't know what mortgage insurance is, I want Rachel to just address that right now because you have to know what that is when you're buying a house.
So mortgage insurance is required on any loan that you don't put 20% down on. What is it? It protects the lender in case you default on that loan. So it's basically like standard insurance,
Insurance.
right? You know, you have
For the
insurance
banks.
on your car, you have insurance on your rental. The insurance you pay monthly, and it covers a portion in case there's some sort of an accident, right? So it's the same thing with a mortgage. It protects the lender in case you, the borrower, default on the loan. It's not required if you put 20% down, but if you put less than 20% down, it is required. How much is it? It's going to depend on two factors: your credit score and the amount you put down. The higher the score and the higher the down payment, the lower the rate is that you'll pay on that, because the lender sees that you're less of a risk.
You're less of a risk,
right?
essentially.
So we can go over those questions in detail should you want to learn a little bit more about it. But the great program about one of these grant programs is you get a discount on that mortgage insurance. So the mortgage insurance is lower with these grant programs. You touched briefly on the closing costs. One thing that's super cool about these programs is that down payment assistance doesn't just have to go to the down payment. So if you qualify, let's say, for a 5% down grant program, and you're a first-time home buyer, meaning you can put as little as 3% down on a home, well, you can use 3% of that 5% grant, and then the other 2% can go towards to cover your closing costs.
So you could, in a beautiful scenario like
Perfect
that, in a perfect world, potentially come to the table with nothing. But in
Right.
most cases,
You're gonna have a
you're
gap.
going to have some
Yep.
money. And I think you were saying, ideally, you would want to have at least 2 months
Yeah,
of
of the-
reserves in the bank.
Yeah.
You know, they want to see that you have a little bit of money. You can't come and go ask to get a house loan with $2 to your name. It's probably not going to happen. Like, be realistic
Yeah.
about it. And then a couple other things before we run out of time that I really wanted to touch on was the fact that there's a little more to this program than is in a typical pre-qualification. So
Yeah.
like if you go get a normal pre-qualification, you're going to submit some documents, they're going to run your credit, and then they're going to give you, based on the information you give them, like basically a pre-qual up to a certain amount.
Yep.
And in this instance, it requires a little bit more. So can you just talk to them
Yeah.
so that way you're prepared? Because if you think you're going, oh, I qualify based on this bucket list for the zero down program, there's maybe a piece of the puzzle you're
Yeah.
missing.
So these programs are not underwritten through the lender you're using. They're underwritten through the actual program itself. So you're going to want to have a little bit longer of a contract time on these programs. Right now, you know, any lender, any great lender can close a loan in 15 to 20 days. These programs do require a full 30-day close, but in addition to that, you do have to take a homebuyer class. So it's out of pocket. You have to take that class, and you will get a certification that you'll provide your
How
lender
much is
with.
the class?
$100.
$100.
And you can take it online. It's really simple. So just a heads up on that. Know that you have to take this class, and you have to provide the lender with your certification for the class. Super easy. Just talks about best practices. And then in addition to that, what was in addition to that?
Anything else that is required that's different from a traditional
Extra fees.
pre-qual? Additional fees.
There's a little bit of extra closing costs required because it's underwritten through the program itself. They do have a little bit more fees than your standard loan. In addition, they'll have a little bit of a higher bit of a closing
I
cost
think
or
for
interest
the
rate.
extra fees that we figured out, $7,500 over 5 years. Is that what we figured?
In some cases, it depends on your
varying.
loan amount.
Yeah.
Because the interest is higher on these programs, over time, it's going to cost you more to keep this loan, right? It's going to cost you about $7,500 on average over the first 5 years of your loan.
Mm-hmm.
Most borrowers are going to refinance before then. That's the other thing. These programs do place a second lien on your property for 3 years. So if you do try to sell it within 3 years, or you do try to refinance it within the first 3 years of owning it, they're going to require that you pay back the amount that's owed on that grant.
In full in the grant. So whatever the loan is
Whatever
and the grant amount.
When you sell the home, your loan will be paid off,
for.
correct? And then whatever's remaining of
Is
the
the
grant,
grant. Okay.
would need to be
okay.
paid.
So that's super important to understand, because if you do decide to refi or sell, you want to make sure you have enough equity to cover both of those.
Yeah,
Okay.
and you want to make sure that the cost to do those things and the cost to pay off the grant
Makes sense. Makes
it may
sense,
not make
yeah.
financial sense. That's why it's working with somebody like Megan who's going to really paint a great picture for you of a total cost to sell and a total cost to buy, down to what's it going to cost for you to move or get a pod or get a
There's
short.
a lot of other expenses
There's a
that
lot
people
of
don't
expenses.
consider. Yeah.
So we want to make sure that it makes the most sense for buyers. But overall, it's an incredible program that gets people into homeownership, and this is a great time to buy, and it's a great time to take advantage of these programs.
Yes. The interest rates in general are low. So outside of even just being part of the zero down program, if you want to buy a home and you're not a first-time homebuyer or you don't qualify for zero down, in general, right now is a fantastic time to go get your pre-qualification for whatever program you're going to do and make 2019 the year that you become a homeowner. Stop giving away your money and start building your own wealth. Okay, I saw something the other day that said, it was a quote by someone who I'm sure was important, but it said, millennials who are not buying real estate are not making good decisions, okay? Because I think in general, millennials tend to live like a lot of times just personality traits, but by the seat of their pants, and they want to go and blow and
they want
vacations,
the avocado
and they
toast,
want
baby.
avocado toast, and they want their Starbucks, but they don't want to
Yeah.
save to buy a house. And what they don't realize is at the end of the day, if you make the investment young, the long-term payout is
Think
so
of it as
worth
your
it.
retirement.
It's your retirement.
Think of it as an investment.
But we are over 10 minutes.
We're over.
So we're gonna pop some bottles.
Pop some bottles.
Have a great day.